U.S. stocks rose across the week, with the S&P 500 notching up an eighth straight weekly gain, whilst the Dow Jones also booked its first record high since February, having lagged the Nasdaq and the S&P 500 owing to its lack of tech stocks. Now, oil prices have fallen. Brent's down just under 5% this week, and Treasury yields have also eased after rising to significant levels earlier in the week as the market continued to weigh up U.S. Iran developments, or should I say lack of. Will it be more of the same next week? Well, to talk us through what he will be watching, I'm joined by John Kicklighter, Global Head of Content. Thank you for joining us, John.
Thanks for having me.
So, John, it's a long weekend in the US and the UK this weekend, but what market conditions are you expecting next week, and which markets are you watching?
So we have a conflict. We have a risk-oriented, risk-on market with some expectations of seasonality. So we go into the summer doldrums, as we usually consider, and we are also seeing especially during this period of U.S. and U.K. lacking liquidity, a period of general quiet or low volume and just slow performance. And we have that backdrop of that risk reach that you mentioned. We have a stretch, although I have to point out that it was not a very momentous climb this past week. Even though we had NVIDIA earnings, we saw the return of the AI theme, and we have certainly suppressed our concerns around the U.S. Iran ceasefire and its tenuous back and forth in headlines. So it's more of a passive oriented market with the risk orientation, and consistency is usually the order of the day. However, we carry a lot of risk going into a quieter market condition. There's that sense that we can just set it and forget it, a passive hold. But we take on a lot of exposure when we're at record highs like these. There's a lot of risk, especially disproportionately in some of these concentrated benchmarks that we have, like the Nasdaq or the tech-oriented stocks, and that's going to leave us somewhat exposed. So the possibility of volatility is still absolutely there, although everything remaining equal, we would expect normalcy. We would expect slower trading conditions, but we have to be open to the possibility that we have a turn in the U.S. Iran headlines, either perhaps a breakthrough and they actually have a lasting peace agreement, or we have military attacks because the frustration of the White House that they're not getting their requirements met. So it can go either way. I would say, though, that the most problematic outcome would be if there is a expected lasting peace accord, and then subsequently the markets do not seize upon that for further highs, because I think there's a lot of anticipation built into the market that when that is removed, it can offer some lift. And if it doesn't, that is going to be somewhat problematic. But that's the outlier probability, because they have been going back and forth for weeks now. In general, the market approach that I'm taking is just looking for ranges and looking for short-term reversals within those ranges. For trends, obviously the orientation is still bullish in terms of risk-oriented trends, but not really playing them for expectations of long hold and duration. It's really that looking for pullback within the prevailing trend and seeing where we could actually pop back up to within that extended rise. And then breakouts, I'm really reserving. Breakouts meaning actual follow through. I'm really reserving for the downside, and that's only if things start to turn tangibly worse. And that is a big threshold to cross, because these markets have been proving very resilient to the negative headlines. But markets to watch, definitely keeping eyes on all the major U.S. indices, particularly between each other. So Nasdaq 100 obviously needs to draw our attention. The Nasdaq 100 versus the Dow, so ratios and that concentration. Also ratios of small cap versus large cap. So you can look at the Russell 2000 versus the Dow Jones Industrial Average. I'm going to be watching all the volatility indices. So the VIX obviously is very noteworthy, but also OVX, the Oil Volatility Index, the MOVE, which is the Treasury Volatility Index. We could also look at the Emerging Market Volatility Index. We should be watching to see how these implieds are playing out, because it's essentially how much hedging the market is doing against, for many of these benchmarks, record or seasonal highs. So we have to see how the markets are treating that risk profile. Of course, U.S. and U.K. oil, and a number of dollar pairs. I'm particularly interested in the dollar yen, the Kiwi USD, the dollar CAD, and even the USD CNH, the Chinese yuan, because there's a lot of dollar versus major FX consideration there.
Now, you briefly touched on some themes there with the AI theme and also obviously US Iran, but what are the most potent themes? Talk us through those for next week.
So when we talk about themes, we have to, and I know it's frustrating, keep very close tabs on the U.S. Iran situation. And it's because it is so much potential for relief, although I think we've priced in a lot of that expectation for relief, but also it can get significantly worse, unfortunately. And the longer that it extends, it's going to have a compounding impact on the global economy. It's just not going to be realized for weeks or months later. And the markets seem to be very concentrated and focused on what's happening here and now. But if we look at those headlines and if there is a significant breakthrough for peace, or if there is a re-engagement of military actions, that can have a very material impact, at least in the short term, for market volatility. So you have to keep tabs on that theme. Just don't get drawn into the it's a right around the corner language, because it has been used far too often, where we have to look for something a little bit more tangible. So maybe stay off Twitter for a little bit. I would also keep very close tabs on the AI situation. So if we're getting away from the U.S. Iran, AI is a bullish orientation. It hasn't really gained as much traction as one would expect, but there's a lot of talk around it. We also have the IPO market, which is coming around in this kind of period of breath inhalation, markets looking around at actual opportunities. IPOs, some significant IPOs are coming out in the AI space or SpaceX. Those are very large. We can always go into something new if U.S. Iran is resolved. It looks like the United States is eyeing Cuba, would be yet another situation that we have to keep tabs on. But generically, we also need to be looking at trade deals, which are unresolved. We need to look at deficits, which are burgeoning, private equity uncertainties, and especially the rise in yields in the sovereign debt market, especially at the long end of the curve, really reflecting all of these issues. And in terms of the more traditional themes, so not the systemic and open-ended and abstract, but more so what's on the economic docket, I would put it at a medium risk. We don't have a lot of that really dense, singular opportunity event risk on tap. We don't have non-farm payrolls this week. We don't have a FOMC rate decision this week. But we do have some noteworthy event risk. So I would keep an eye on Fed speculation, because that will certainly unfold. We have some central banks, although they're not the top tier. They're the RBNZ, the South Korean and South African Reserve Bank. We have some very key emerging market GDP figures, which will be very important. They're a very large component of global growth. And there's going to be a specific update on a number of data points for Canada. So if you're in Canadian markets or looking at Canadian markets, certainly going to get its update.
So yes, moving on to event risk. Talk us through the top event risks for each day next week.
So we have to start with Monday. Monday is going to be a very, very thin day for the session. Obviously, the U.S. and U.K. and a few other countries are offline for their respective holidays. There still is a significant amount of liquidity, but when the U.S. and U.K. are offline, it tends to drain a lot of the expectation for what kind of transmission of volatility and to follow through you're going to have. And there aren't a lot of major events outside of these countries that are offline. So I don't really see a whole lot of potential unless there is a just seismic change in the headlines. That's always a possibility, but Monday is very likely to be a quiet day, unless it's an extremely volatile day because of a headline uncertainty. Tuesday, we get into some more active event risk, more so in the Americas session. Canada has manufacturing sales, so we want to keep tabs on their health, and especially in manufacturing, because it's a very important component of their economy. In the U.S. session, we have the Chicago Fed National Activity Index, we have housing prices figures, and I will be watching very closely that consumer confidence report from the Conference Board, especially after the U of M's sentiment survey had its final reading and it plunged even further into record lows. It is a very big contrast to the Conference Board's figure, so we want to see if it's going to follow along or continue to offer that contrast. Wednesday, Chinese industrial profits, very important for the corporate health in China, which is a very big component of their overall growth. We have Australian inflation, CPI. We have an RBNZ rate decision, which is going to be probably the biggest central bank rate decision of the week. And they are historically a carry currency, so we want to see if they're actually going to follow through and maintain that high yield contrast to many of their counterparts. Thursday, I think we're going to get the South Korea central bank rate decision. We want to see how Asia is responding to some of the inflation pressures. We're looking at Asia, Europe, and U.S. or Americas as we separate them out to see how the world is responding to rising inflation expectations and realized upstream inflation pressures. Japanese housing starts, Hong Kong trade. There's a lot of Eurozone sentiment surveys that we should take in to see how they're dealing with the closure of Hormuz. We have probably the top event risk of the day, I would say, is going to be the PCE deflator from the United States. That is the that is the Fed's favorite inflation indicator. So we want to see how is that giving the context for what the next rate hike or rate cut is going to be, even if it's further out, especially with Kevin Warsh coming in as the new Fed chairman. We have the South Africa rate decision, or South Africa Reserve Bank rate decision. Bank of Canada has a financial stability report, and we even have, I think, U.S. new home sales. So that's going to be our most active day. But if you had to focus on one thing, it'd be the PCE deflator. And then Friday, we have a run of Japanese data: employment, industrial production, consumer confidence, German employment figures. U.S. trade is going to be in the Americas, but I'm really going to be watching that collection of GDP figures from India, Brazil, and Canada also has March and the first quarter. So we'll have more of the emerging market countries' GDP figures in the following weeks.
Well, thank you very much for your views once again, John.
My pleasure.
For more videos like this, please do like and subscribe.